We're here with Steve Hanke, professor of applied economics at Johns Hopkins University. We're talking about the latest GDP readings and its forecast for inflation and economic growth. Professor, welcome back to the show.
Good to be with you, David.
So, Professor, real GDP data did come in last week. This is the first time since the start of the pandemic where we had output at a higher level than pre-pandemic highs. However, 6.5% was the real GDP growth on an annualized basis. 6.5% is lower than expectations. For example, the Conference Board had pegged forecasts at 9%. So were you surprised that 6.5% came in and we did not beat expectations? In fact, we were nowhere close.
I wasn't surprised when the number came in, but it is lower than the consensus number. And my take was that it would be a little bit lower than the consensus. So I wasn't surprised by that. But you have to put the thing into context, David. 6.5% is about 3 times higher than the normal potential growth rate in the U.S. economy, which is more or less back of the envelope around 2% or maybe a little over 2%. So the economy is hot. The real economy is hot. The number of 6.5% is a hot number. Real growth. Now, what that means in terms of inflation implications is kind of interesting because remember, nominal GDP is driven by growth in the money supply measured broadly. So growth in the money supply, what's been happening there? Well, since COVID, the average annual rate of growth in the money supply measured by M2, which is the Fed's broadest measure, has been running at 24%. Now we haven't seen that since World War II. It slowed down a little bit. The last reading was coming in at about 12%, a little over 12%. Year over year growth in money supply. But that, remember, is double what the optimum rate of about 6% money growth should be if the Fed wanted to hit its inflation target. So that means we got juice in the system. We got fuel putting on the fire. In fact, we have a hell of a fire going here. Real growth, 6.5%. Nominal growth is inflation plus real growth. Now, if nominal is a little lower than the consensus thought, what's that mean? That means the residual inflation is probably going to be a little bit higher than they thought. And what I think is my estimate that I've done with John Greenwood, chief economist at Invesco. John and I think the inflation will end the year based on our monetary model and the equation of exchange at about 6 to 9%, something in that range. This latest GDP number, a little weaker than the consensus, means that inflation will probably be up towards the upper end of our estimate, more towards 9% by the end of the year rather than more towards 6%.
Professor, broadly speaking, do you think GDP is an accurate gauge or has been an accurate gauge of actual economic growth? Because if you consider that real GDP growth 6.5% on an annualized basis, I'm guessing a lot of that was just government spending, right? Government spending is one of the components of GDP. If you take that out, where's the rest of the growth? Where's consumption? Where's investment? Where's everything else?
Well, okay, you do have the government pumping money into what? They're literally making money and pumping it into people's checking accounts, and people use those checking accounts to buy goods and services. So that's what's going on. The idea, I mean, they literally are making money out of thin air right now, and that money is going into people's checking accounts, and there's so much liquidity in these accounts. They've just exploded. By the way, the checking accounts in the United States have grown at almost exactly the same rate, almost 24% year over year since the COVID started. And that money, a lot of it is being spent on real consumption. I mean, people are buying things. things. That's why you've got inflation. The producer price index is the first thing that starts inflating, and that's at the beginning kind of the supply chain, goods
Okay.
in process, things like that. Then you've got another index, David, and that's the prices for consumer goods. That hasn't been going up as fast as the producer price index, but it's been going up very smartly. And then the last thing, the more general thing, you've got the consumer price index, and then the most general of all is a GDP uh, inflator.
Hmm.
So so you have a bunch of different measures going on, and all of them reacting differently to what? The Go back to the basics, the money supply. It's the money supply that dominates everything.
Right.
So money is being literally created out of thin air
Hmm.
by the government, and of course, it's created out of thin air by commercial banks when they make a loan.
Okay. All right, so
And
let's
so
let's go back let's go back to the real GDP forecast for just a minute before we move on. So again, real GDP is the nominal GDP minus the inflation rate. So if 6.5% came in real GDP and that missed forecasts, let's say the forecast was 9%. So what happened there? Did they overestimate the nominal GDP component or did they underestimate the inflation component?
Well, I think they underestimated the real GDP. I mean, the real GDP isn't a residual or anything. It's just
Okay.
it's the real deal, so to speak.
Right. Right.
The residual in there is the inflation component that's left in, and the inflation component is by definition, if you hold the nominal GDP constant and the real GDP is not quite as great as you thought it would be, the residual is a little bit bigger than you thought it was going to be.
Hmm.
So I think that is the big story in this real GDP report that came out. It was a little below what the models were saying, what the consensus was saying. It's still very hot. It's probably three times the rate of growth potential for the U.S. economy,
All
which
right.
is a little over 2%. So hot real GDP, hot inflation, and why is everything hot? Everything is hot because money dominates, and money, broadly measured, has been growing at a record clip since COVID. It slowed down a little bit the last couple of months, but it's still growing at about twice the rate that would be consistent with the Fed hitting its inflation target of 2%, meaning that the inflation we're going to have in the system is going to be much greater than 2%. And I
Yes.
think, with John Greenwood, that it'll be between 6 and 9% per annum by the end of this year, which is much hotter
Yes.
than than most of the forecasters, by the way, and it's way higher than what the markets are thinking. The markets are completely out to lunch.
Yeah.
They're saying it's as a market man, it's hard for me to utter that statement, but I think the markets are just out of it. They're just
Well,
not reading the tea leaves correctly. Most of these market participants, the bond vigilantes, are no longer these seasoned old veterans. They are youngsters, probably many of them below 30 years of age, who 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 tend to behave like this younger millennial group. They're herd people. They go in a herd. They go with momentum. They're
mhm.
not thinking independently. They don't know how to think independently. And I doubt if most of them have ever even learned monetary economics. I mean, they don't give any indication they understand economics. But that's who's at the bond desk right now. And I think if you can believe, inflation expectation should be shooting up, and the bond market, the nominal yields should be shooting up because nominal yields follow inflation. inflation has been going up. Measured inflation's going up. Even the measured inflation is over 5%.
Yeah.
5.4% right now is a measured CPI number. And you've got nominal yields on the 10-year that are way below that. And the result is you actually have negative real interest rates, which when you have that, something's wrong.
We're going to talk about some of these tea leaves now, Professor. Like you said, these indicators. Real interest rate, this is what this chart shows, has been negative for quite some time. It's trending even more towards negative territory now. Let's talk about bond yields. You mentioned that bond yields have been dropping, and they have been over the last 3 months. First of all, though, Professor, I've noticed that the inflation expectations as measured by the Treasury Inflation Protection Security, the TIP, has been rising. So I guess the people following that market has been predicting higher inflation. But why is it that inflation is rising and bond yields are falling? Can you explain that phenomenon?
Well, because I think the people at the bond desk don't know what in the world they're doing.
What about this? What about this? The U.S. dollar has been rising. The U.S. dollar has been rising, yet bond yields have been rising. Bond yields have been dropping. Usually the dollar rises concurrently with a rise in the bond yields, not a drop.
Right. So that is a little bit of also a disconnect. There are just a lot of disconnects in the market right now.
Yes.
Because fundamentally, let's go back to the basics. The basics are we have a huge amount of money and liquidity that's gone into the system and is still going into the system at an excessive rate right now. And that will mean that inflation must be baked in the cake. We're seeing the numbers. It is sustainable. It is not this temporary thing. They keep talking about temporary, transitory. It's going to go away in a few months. That's what the Fed keeps saying. It's going to stay with us. It's literally baked in the cake. You just work out the numbers, and it's easy to see that you've got it, and it's going to be sticking around. It is not transitory because, as Milton Friedman taught us a long time ago, inflation is everywhere and always a monetary phenomenon. So that's the story, and they're just missing that. They're missing the link between increases in the money supply and what happens. You always, with a lag of between 12 and 24 months, inflation comes. With a lag of 1 to 6 months after the injection of money into the system, you get asset prices going up. Then the next thing you get is the economy starts taking off. We just covered the economy has taken off, even though 6.5% real growth is less than they anticipated. It's still very hot. That's a hot number,
right?
And inflation at 5.4% now that's measured is hot.
Right.
Everything is hot, but the bond market is just ignoring it, and the U.S. dollar is also ignoring it, given the fact that we have negative real interest rates, as you pointed out. Usually, when we have negative real interest rates and low nominal interest rates in the United States relative to everybody else, the dollar gets weaker. It doesn't get stronger, and it's on the strong side. There's no question about it. I think the most important price in the world is the dollar-euro rate, and we're about 118, something like that. I haven't looked actually this morning.
Yes,
but 120 is the strong end of my range. 120 to 140 is kind of the normal range that the dollar-euro rate should be in, and right now we're at 118 with the dollar's damn strong right now. And in addition to this, with these negative real interest rates, you'd expect gold to be taking off, by the way.
Yeah, we're going to get to that. There's a chart for that. There's a chart that I want to show. But before that, Professor, this is another curious chart. GDP is growing, economic growth is happening, yet at the same time we're getting a flattening of the yield curve. This is the 10-year yield minus the 2-year yield. Most economists read a flattening of the yield curve as an indicator for a slowdown of economic growth, which arguably is not happening right now because we have positive economic growth. So why is this curve not steepening? It's flattening.
Well, yeah, it's flat. The yield curve is flattening a little bit, and that also at sometimes is an indicator that the economy will slow down. I think this thing also is the market prices are the objective prices. That's what the market is telling us. I think the market is just misreading this inflation story totally, completely. End of story. That's why all these things you're putting up, David, they look kind of anomalous. You say, well, why is that happening? I think all of these things, it's the same story. The market is not anticipating correctly the surge in inflation that we are actually witnessing right now. I mean, 5.4% is high. Now the markets think, oh, that's going to go away. That's going to go away. We'll go back. It's not going to go away. It's going to get higher, not go away. It's
well, you say
will go higher.
You say the bond market right now is preoccupied by unseasoned traders. What about the gold market now, Professor? Because if you look at this chart, there's a divergence here too. Look at this chart. On the left-hand side, in the blue line, you've got the GLD ETF, which is a proxy for the gold price. On the right-hand side, you've got the real interest rate, the exact same chart that I've shown previously. This is the real interest rate. I've taken this chart and I've inverted it on this chart. So the orange line shows the real interest rate. Now, granted, I made this chart a week ago, so the data is about a week off. I don't have the latest data points on here.
It's close. I saw one this morning.
Yeah, but there's a divergence here as well, is the point I'm trying to make. The real interest rate is heading more into negative territory, yet the gold price has remained relatively flat. Why is that happening?
Well, to continue on with the analogy, or observation I made about the bond market, maybe we've got a lot of youngsters on the gold desks too.
I don't know about that one, Professor.
the whole thing is, again, I think the average age of the people trading gold is probably a little bit higher than it is the bond market. But be that as it may, the point is all these market participants now, we're in a herding world. We're in a herding world. Whether they're young, old, or middle-aged, it doesn't make any difference. The herd moves things. You look at if you get some of these apps and so forth that people are following, I mean, everything is a momentum trade now. Everything is an echo chamber. Whatever somebody says, utters something, oh, we're not going to have inflation. We get the chairman of the Fed, Jerome Powell, comes out in February. He said money doesn't matter anymore.
Yeah.
So everybody says, oh yeah, money doesn't matter anymore. I guess Powell's got a point. And then it echoes around and around and around. And if you talk to people that are market participants, I can tell you they'll tell you the same story. All of them will tell you the same thing. Now, the thing that's interesting, if that's the case, if my conjecture is correct, and I think it is, this is a perfect time for old timers like me who are contrarian traders. If you get the herd, if you get 99.9% of the herd moving one way, and you're convinced that fundamentally they're wrong, as a contrarian, you're going to make out like a bandit, because eventually the fundamentals will come into play and they will dominate. And in this case, money will come into play. Money will dominate. Inflation will come in the picture. The bond market's going to turn around. The gold market will take off. Real interest rates, due to the fact that nominal interest rates go up, and they will, because nominal interest rates always follow inflation.
Right.
Period.
Okay.
They eventually this will happen. So for people who can think independently and have the guts to be a contrarian, this is a beautiful opportunity for them to
Yeah.
be in the market. You want to bet against all these youngsters. If I don't think they know what they're doing, you bet against them.
Okay. Let's talk about this chart then. What's going to happen now? All right. So is the orange line going to come down? Let's assume the negative relationship between gold and real interest rates hold. Let's assume this divergence closes. The question is gold going to catch up? Is it going to go up? Or, like you said, are negative real interest rates going to climb into positive territory first? What's going to happen first? What do you think?
Well, I don't know. I don't know what's going to happen first, but those two lines will start to converge.
Yes.
And that, the negative real interest rates will become less negative, and gold will take off. I mean, I think the gold market's getting set up to take off, actually.
Well, your index here is interesting. This is the the Hanke Gold Sentiment Score. And we've talked about this in the show. We update this every time you're on the program, Professor. You track various media sites around the internet, and you devise a score based on the keywords that you've tracked and the sentiment that these keywords give you. Right now, your sentiment score is around neutral territory. Let's just take a look at this chart here. So, well, as it should be, gold price hasn't really done much in the last week or two. So you're saying that this score indicates a move to the upside?
Well, the reason I say the move to the score is neutral. In other words, if you have a position, obviously you shouldn't be selling it. You just stay in neutral, and wait until the sentiment starts turning around and gets over on that green positive side on the right. But that chart that you just put up, the 8-day moving average, the other one, David, yeah. That, if you look at that thing carefully towards the right-hand side, you've got a couple of double bottoms in the Hanke Gold Sentiment Index. And you have a double bottom, and then it goes up, and then it's come down, and you got another double bottom. And then the sentiment goes up. In the meantime, the gold price has gone up a little. It's been kind of neutral. It's been neutral, but I think it's getting set up and developing a huge base in here. And once that happens, of course, it's a great time for a blast off. You've got a good base built, blast off.
All right. Okay, blast off. Now, before we go, Professor, some people have been asking whether or not they can track your index live. Can they do that yet?
Here's what Abe Kaufness and I are working on. And as I said, this whole exercise is experimental, kind of a pilot project, is working very well. We're setting up, and we'll have in a couple of weeks, and I will announce it with you on Kitco. We will have an app that will be for people who volunteer. It will be free of charge. It will go on their iPhone, and they'll be able to track that gauge hourly. That needle that you have on that one chart, they'll be able to see that. Yeah, right. They'll be able to see that on their iPhone. We're getting there. We're within a couple of weeks of facilitating that and going with it. Right now, I can report that the sentiment index, the Hanke Kaufness Sentiment Index, it is working like a charm. It's working like we hoped it would work. It is working very well.
Excellent. So let's follow up as soon as that's ready to be released to the public. Professor, thank you so much for your update today. Thank you so much.
Thank you for having me.
And thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and follow me on Twitter @DavidLin_TV.